Hello, everybody. This is Hard Money Jim back from summer vacation and speaking to you from Jackson Hole, Wyoming, where we're having another spectacular summer. Come visit us sometime if you've not been here already. And if you have, hey, come on back. You know, the process of money creation is widely misunderstood, even by many people who are considered financial experts. I made this point using numerous examples in chapter one of my book, Black Hole in Economics. And this widespread misunderstanding is not a good thing because if we don't understand how money comes into existence, who caused it to come into existence, and where that money is then spent and respent, we will not be in a position to understand the dynamics of inflation, which means we won't be able to defend our wealth from inflation's corrosive effects. For example, unless you understand how money is created in the banks, you will not understand the origin and spread of asset bubbles, such as the Japanese asset bubble of the early 1980s, or the worldwide housing bubble of the early 2000s, which culminated in the great financial crisis, or the stock market bubble that we're in today. These are all egregious examples of inefficient and destructive money creation that propagated waste and malinvestment throughout the entire world economy and brought countless people to financial ruin, even though most people really never understood what was happening. Now, consider this frequently quoted passage from the 20th century's most influential economist, John Maynard Keynes. This was written in The Economic Consequences of the Peace, 1924. Lenin is said to have declared that the best way to destroy the capitalist system was to debauch the currency. By a continuing process of inflation, governments can confiscate secretly and unobserved an important part of the wealth of their citizens. There is no subtler, no surer means of overturning the existing basis of society than to debauch the currency. The process engages all the hidden forces of economic law on the side of destruction and does it in a manner which not one man in a million is able to diagnose. Now, consider the depth and the seriousness of that statement. When he's discussing inflation, Keynes is not just talking about a rise in the consumer price index. He's explains that inflation is a hidden and indirect process that is sure to cause damage. It involves much more than just increasing consumer prices. It includes all the hidden forces of economic law that lead to destruction. Keynes says inflation not only destroys the current foundation of society, but that you, the average person, are powerless to understand it. That's pretty heavy stuff. Now, Keynes claimed that not one in a million can diagnose inflation, but I think we can prove him wrong. Because if you understand how new money is created, who creates it, who gets it first, and how it is then spent and respent in the economy, you will be able to grasp all the so-called hidden forces of economic law that make inflation so destructive. And this knowledge will help you protect your savings, which represents the tangible value of your life's work. And it's a record of your financial success and the key to your long-term financial security. And therefore, understanding money creation is a vital part of financial self-defense. Now, there's another important reason why you, as a citizen and a voter, need to understand the fundamentals of money creation. Our financial system is already faltering, and someday, perhaps soon, it may fail, requiring us to elect better representatives to rebuild the financial structure. If you understand how money is created, you'll know more than most politicians, giving you a better chance to choose legislators and regulators who will not repeat the mistakes of the past. Whatever the future monetary system ends up looking like, you can be an active participant rather than a passive observer. So here is an overview of today's chat. First, to support my claim that many so-called financial experts are misinformed about money creation, I'm going to flag a few typical errors from prominent people that I've seen just in the last few weeks. And these will augment the examples I gave in my book, where I cited surveys of politicians and reviews of erroneous college textbooks that prove that many financial professionals and academics are very confused about this topic. So we'll start by calling out some major errors from some prominent people that you probably have heard of. Now, next, I'll explain an important feature of banking and money creation by responding to questions from viewers about some of my recent videos. And now, one of these questions has to do with whether stablecoins really are a new form of money. And I have some new thoughts on that, which I'd like to share with you. And finally, because I always want to offer you some, so-called cash value in exchange for your listening time, I'll offer up a little practical investing advice addressing why you might want to consider investing in gold and silver mining stocks to augment your personal savings and investment program. First, let's look at some monetary mistakes made by some prominent experts. The first example is from an interview of David Stockman by Adam Taggart of Thoughtful Money. Thoughtful Money is an excellent YouTube offering that I enthusiastically recommend. Adam Taggart, the host, interviews lots of different investment professionals, and he does it with great objectivity and civility. So you can listen to different points of view and choose the investment style that makes the most sense to you. Again, I recommend you check him out. His name is Adam Taggart, and his channel is called Thoughtful Money. A few weeks ago, Adam interviewed David Stockman, a former congressman and White House budget director under the Reagan administration. And Stockman writes a subscription column called Contra Corner. And to his credit, he understands the mechanics of government budgeting as well as anyone I know of. And on this subject, he's very well worth listening to. This interview was focused on the current dire state of U.S. public debt. Now, this is where my first example of monetary illiteracy comes in. Toward the end of this interview, Stockman shares a story about a conversation he once had with George H.W. Bush, who was vice president during the Reagan administration and who later became president. That was from 1987 to 1991. Now, this story surprised me, but it shouldn't have, given my observations of politicians' ignorance about money creation. So I'll now let you listen to Stockman's brief story. He's talking about a conversation with Vice President Bush that occurred after a White House budget meeting.
Do you mind sharing that one little anecdote with folks here?
And we had just had an economic briefing by the Treasury Department, which at the time was totally bifurcated between the supply-siders, who were just all about tax cuts and fiscal policy, and the monetarists, who thought everything was driven and determined by the Fed and exactly the rate of money growth to the decimal point. And we just had a briefing by the Undersecretary of the Treasury, who was a hardcore monetarist and who was ranting and raving that there wasn't, that we're going to be in trouble. We're going to have a recession because the Fed is too tight. They ought to be expanding the money supply, like at 5% versus 4.1% or something like that. Mm-hmm. So he just kept pounding that they've got to start using the printing press. That's what it's there for. You got to tell Volcker, crank up the printing press. So on the way back, I was walking with Vice President Bush, who wasn't his field was foreign policy, not economics. And he kind of asked me on the way, he said, well, is it true there's actually a printing press in the basement of the Treasury building? So anyway, I realized right then that economic policy wasn't his forte.
Well, let me ask you this, because I've made this point a lot. So I think one of the things people who generally, people with your background, an economics background, who go to Capitol Hill, one of the things you realize quickly is, whoa, not everybody here who's making decisions has a good degree of financial literacy or economic literacy. And I think that's a really telling example where the vice president was like, do they actually have a real printing press in their basement?
Yeah.
So did you get that? The vice president of the United States says, is it true there's a printing press in the basement of the Treasury building? George H.W. Bush was not a foolish or a naive man, which makes it nearly unbelievable that he would ask such a question. But his question does show that he didn't understand how the Fed influences the money supply or what causes inflation. And of course, George H.W. Bush succeeded Ronald Reagan as president of the United States. So please let that sink in. The vice president and later president of the United States had no idea how money is created, which means he didn't understand how inflation works or how federal spending can be monetized to generate asset bubbles and wasted capital? And do you think it's possible that other politicians, like senators and congressmen, and even financial regulators who are appointed by the president and or the Senate, also have no idea how bank credit creation influences the money supply? So based on this story alone, I think we're entitled to make the logical leap that our politicians and regulators are massively ignorant about our financial system. And please tell me if you think I'm wrong. Now, that story goes back about 40 years, but my second example of monetary illiteracy is even more recent. In fact, it's even more surprising because these comments I'm about to share come from a well-known economist who once interviewed for a job at the Federal Reserve. I'm talking about Judy Shelton, a popular supporter of free markets and an advocate for sound money and the gold standard. And in the clip I'm about to play, she was interviewed, and this was just a few weeks ago, by Ben Nadelstein of Monetary Metals and Company. I'll now let you listen to the relevant part.
So what I'm referring to is not what we call a federal funds rate. That really doesn't exist. We're talking about what is the interest on reserve balances? What does the Fed pay on the 3.4 trillion parked in cash at the Fed, held by private commercial banks, to not do anything with it, to let it just sit there corralled and not be loaned out? And why are we paying more than twice what the ECB is paying? And you look at the Bank of Japan, theirs is 50 basis points. The Bank of Canada, I think theirs is 2.75. That is why the hundreds of billions that the Fed pays out in this interest on reserve balances, and it's over 620 billion since the Fed started running an operating loss in September of 2022. Over 40% goes to foreign institutions, foreign banks. I mean, how is it that we don't have, and again, with this world of globalized finance, and we talk about reciprocity on trade, our banks get that operate in their markets, get their rate. Their banks are getting more than twice. Again, I'm looking at the ECB, the rate they would get if they kept that cash at home. So they set up operations here. They're allowed to have a master account at the Federal Reserve. And if you look at their balance sheets, mostly they just keep cash at the Fed. That's a big part of their operations. Loans are a small part. And so this is money that actually, all the money the Fed makes off its own massive portfolio, 6.7 trillion, that would normally be remitted back to Treasury as revenues to the budget, paying for schools and Medicare and all the things that revenues to the government provide for as outlays. That money is going not just 100%, but 100 plus. The Fed's going into debt every day, paying that money out to private commercial banks. It's a huge subsidy for them. And at looking at last week's H.8 numbers from the Fed, over 44% is going to foreign banks operating in the U.S. So this is crazy.
So to recap, Judy made 3 points here. Her first point is bogus, and the next two are valid. Point one, she says the Fed pays private banks interest on the cash reserve balances they hold on account at the Fed. And she says this practice encourages the banks not to lend out that money. Now, I say this claim is untrue because it rests on a false premise, which we're going to expose very soon. Her point two was that 44% of this interest on reserve interest paid on reserve balances goes to non-U.S. banks. And that is true. Her point three, the Fed's source of this interest that they pay out to the banks is interest that the Fed, earn on their bond portfolio, consisting primarily of treasuries and government guaranteed mortgage-backed securities. And this is money that would normally be remitted back to the Treasury, helping to offset the federal deficit. Therefore, paying out interest on reserves adds to the deficit to the tune of about $180 billion per year. Now, that's also true. So her points 2 and 3 are correct. So let's talk about point 1. She claims that when the Fed pays interest on cash reserves to commercial banks, it is incentivizing the banks not to lend out that money, to let that money, quote, just sit there corralled and not to be loaned out, unquote, as she put it. And this makes me wonder if Dr. Judy Shelton, PhD, even knows what she's talking about, because banks do not lend out the reserves when making loans. We know from the many sources I cited in my book and others which I'm now going to cite below, such as Richard Werner's famous empirical experiment that I summarize in chapter 3 of Black Hole, that banks create new deposits when they make a loan. They do not lend out their reserves. This is the erroneous teaching of Paul Samuelson's fractional reserve theory, which is still taught in many college textbooks. To understand this, let's briefly reserve what cash reserves are. Cash reserves, or quote just quote reserves as they're usually called, consist of the paper currency held in bank vaults and the electronic cash deposits that banks hold in their reserve accounts at the Federal Reserve. Reserves are used by commercial banks for two main reasons. First, to balance transactions when bank deposits, which make up the bulk of the broad money supply, shift from one bank to another during normal economic activity. So, for example, if I write a check from my bank account to you, and you then deposit this check in your bank, my bank sends cash reserves to your bank to settle the transaction. This way, my bank no longer owes you the promise to pay out cash on demand. That obligation transfers to your bank. Now, the second reason bank needs reserves is to meet withdrawals from deposit accounts. So when you withdraw paper cash from your bank account, your bank deposit goes out of existence, but the paper money that you have in your hand now circulates in the economy. So in effect, the money leaves the bank account and becomes paper cash. No new money is created. It just changes its form. Now, here is a picture of how Judy thinks a bank lends money. She believes that when banks lend money, they're lending out their reserves, their cash assets. However, if this were true, the bank's balance sheet would change as shown here. Before the loan, the lender has a cash asset. After the loan, the lender has a new asset, the interest-bearing loan that replaces the cash that was loaned out. The total asset value remains the same, with the new loan replacing the cash. On the liability side of the balance sheet, no new deposits are created. This is a common but incorrect view of banks as financial intermediaries, acting as intermediaries between depositors and borrowers, meaning the bank must first receive a cash deposit before it can lend it out. Now, the accounting scheme here, shown here, is what happens when a non-bank financial institution lends out money, not when a licensed commercial bank lends. According to Judy's perspective, then how is money created in the banks? She seemingly accepts the flawed and discredited Paul Samuelson money multiplier theory, which states that new money is generated when a borrower deposits their loan at another bank. This deposit is considered a new liability of the second bank, balanced by the cash transferred from the lending bank on the asset side. It suggests that one, the bank must receive a cash deposit before it can lend money, and two, that the bank lends cash by writing a check or giving cash to the borrower. Three, that no new money is created until the lender deposits his loan proceeds into another bank. And four, that only a system or a network of banks can create money, not any single bank, because you have to deposit the check or your cash into another bank before new money comes into existence. Now, each of these points is incorrect. The bank can create a new loan without receiving a prior deposit because banks do not lend out cash or cash reserves. Point two, the bank does not write a check against its cash balances to make a loan, but instead creates new money when it grants a loan by simply crediting the borrower's account. Point three, depositing money drawn on one bank into another does not create new money It merely moves a bank deposit from one bank to another. And point four, multiple banks are not necessary to create money. One bank alone can create as much money as many banks. And this last point is demonstrated by the fact that monobanks in a state-run economy can generate all the money the economy needs and even more. And in fact, it's these economies that are most prone to excessive money creation and inflation. So Judy's version of events is incorrect in its understanding of bank accounting because it doesn't recognize that banks expand their balance sheets at the point when they lend or invest, at that point. In particular, she's incorrect because she believes commercial banks have to have cash reserves in order to lend them out. Now, here is the correct picture of how bank lending or investing works. It shows changes in the bank's balance sheet after it makes a loan or buys a bond. When a bank lends, it buys the borrower's promissory note, and it funds this investment by crediting the borrower's account. This process is called a bank loan, but in reality, the bank isn't really lending money in the same way you might lend out your car to a friend for the weekend. Instead, the bank is acquiring a new asset, a promissory note, and it records this asset as a loan on the asset side of the balance sheet. It pays for this asset by giving the borrower a promise to pay out cash on demand. And this is what they call a bank deposit. That promise to pay functions as money, and it's valued in the economy and exchanged just as if it were physical cash. Now, importantly, this is how new money has been created in the banking system for hundreds of years, even under a gold standard. This illustrates the unique ability of licensed banks as differentiated from other financial institutions. Banks have the unique legal privilege of creating money. So in light of these facts, I need Dr. Shelton or someone else to explain why the Fed paying interest on reserve balances is an incentive not to lend. It's true that this practice gives banks extra profits. It's kind of a subsidy. But I would think the additional money these banks earn from this subsidy might make them feel even more secure about making risky loans, so they might be even more willing to lend. Whether it's true or not, whether that particular point is true or not, is really not the main point. The main issue is that a well-known PhD economist and a candidate for the Federal Reserve Open Market Committee doesn't seem to understand money creation. Now, Judy's comments were echoed a few days later when Senator Rand Paul appeared on the Larry Kudlow show on Fox Business Network. Senator Paul said essentially the same thing, expressing outrage that the Fed was, quote, paying commercial banks not to lend money, unquote, and he is now supporting legislation that would prohibit or limit this practice. Now, again, there's a lot to like about Rand Paul. I respect him. But in this case, he has revealed a fundamental misunderstanding of how our banking system works. To be fair to Shelton and Paul, there is more to the issue of interest on reserves than the mechanics of money creation. There may be good reasons to prohibit or reduce the interest the Fed pays on reserves. However, they're both mistaken in their assumption that the banks lend out their reserves and that this causes banks not to make loans. So I predict that very soon these two will stop making this argument once they are corrected by people who know better. Now, you may be skeptical of what I say. You might be asking yourself, why should I take, my word? Why should you take my word for this rather than the word of a well-known PhD economist and a sitting U.S. senator? Well, I'll give you two reasons. First, I'm going to call on my own experts who directly contradict Shelton and Paul. So this quote is from a 2014 paper published by the Bank of England. And of course, it's from the Bank of England, but all central banks work the same way. So it would apply to any central bank. Quote, the correct description of money creation contrasts with the erroneous notion that banks can only lend out pre-existing money outlined in the previous section. Bank deposits are simply a record of how much the bank itself owes its customers. So they are a liability of the bank, not an asset that could be lent out. A related misconception is that banks can lend out their reserves. Reserves can only be lent between banks. since customers do not have access to reserve accounts at the Bank of England or any central bank. I could list many more sources, but instead I'm simply going to reference several of them in the bonus material that's included in the PDF transcript attached to my Substack. Identical points are made in an extensive paper published by Deutsche Bank in 2017, by a speech from the chairman of the Swiss Central Bank in 2018, and by the first chapter in a new book called The Age of Debt Bubbles that came out in late 2024, and of course in the many papers of Richard Werner. So refer to the PDF if you want to dig into this question, and verify what I'm saying. Okay, let's stay on the topic of money creation errors to answer a good question I got from a viewer of my last YouTube broadcast. This question was from Chris, who objected to my claim that when commercial banks purchase treasury bonds in the open market, they create new money to do so, just like they do when making a normal loan. I further said that because these purchases do not result in any new products or services, that this kind of money creation is, quote, unambiguously inflationary. Those were my words. Now, here is Chris's objection. I have bolded the most relevant parts. He says, no, that's completely wrong. When banks buy treasuries, they're not injecting new money into the system. They're just swapping reserves for bonds. Both of these reserves and bonds are already inside the banking system. No new credit is created. No new purchasing power enters the economy. Banks don't create money by buying treasuries. They create money by lending. If they're not lending, and in contractionary conditions they aren't, then no new money is created, period. So he's saying lending is the only way to create money, okay? First, I appreciate this viewer's engagement, which is an intelligent question because it contains an element of truth. Chris's statement would be correct if the commercial bank buys treasuries not in the open market, but from another bank or from the Fed. Now let's look at this a little closer. When a commercial bank buys a treasury bond from another bank or from the central bank, in this case the Fed, the commercial bank is, as Chris says, just swapping reserves for bonds. In that case, no new money is created. This is what Chris is referring to when he says that both the bonds being purchased and the reserves used to pay for them are, quote, already inside the banking system. Now, similarly, if a commercial bank purchases a treasury bond as an investment at one of the treasury's monthly auctions, in other words, if it purchases direct from the treasury, it must use its reserves to pay because the treasury only accepts reserve money from the commercial banks. They don't accept checking accounts. In other words, the treasury does not maintain accounts at the commercial banks as it used to before the great financial crash. Nowadays, all treasury money is held at the Treasury General Account, the TGA, at the Fed in the form of cash reserves. So if the bank buys directly from the Treasury, the bank's reserves are transferred to the Treasury's General Account, the TGA, which keeps all its money on account with the Federal Reserve in the form of reserves. And in that case, the bank's balance sheet does not expand. It simply swaps reserves for the Treasury bond. However, the Treasury's money will soon be spent as the Treasury pays money out, into the economy for services and entitlements. When it does that, when the Treasury does so, the Treasury writes checks to various recipients and vendors who then deposit these checks in their bank accounts. And when they deposit this money, new bank deposits are created. So simultaneously with the deposit of the Treasury's check into a commercial bank, the Fed transfers an equal amount of the Treasury's reserves to the receiving bank's reserve account. See how that works? So when the Treasury writes checks to citizens, new bank deposits are created and the new bank reserves increase in equal amount in the banking system. So technically, new money, M2, is created at this point. But I think it makes more sense to say new money was created when the bank bought the bond with its reserves. And that's because the Treasury's reserve account will soon be spent, just like any checking account at a bank. This is why in my book, in Appendix 1, I argued that the Treasury General account should be counted in the broad money supply, because rather than leaving the economy, the Treasury's money held in the TGA is going to be spent very soon. And most Austrian economists agree with me on this point. It's a technical point, but it's part of a full understanding of money creation. And you can read about it in Appendix 1 of my book. But that technical point is not the real issue with Chris's question. Here's the real issue. The fact is, commercial banks rarely purchase bonds for investment purposes directly from the Treasury or from another bank or from the Fed. Almost all the time, they purchase bonds from a non-bank investor on the open market. When they do so, banks, in fact, create new bank deposits in the bank account of the seller of the bond. And this adds to the money supply just as if the bank was making a loan. Now, this should make sense because buying a bond and making a loan are essentially the same activity. When making a loan, the bank is purchasing the borrower's IOU, or promissory note, and the bank pays for this by creating new bank deposits. Similarly, when purchasing a bond, whether it's a treasury bond, a corporate bond, or a municipal bond, the bank is buying the borrower's IOU by creating new deposits. So Chris's claim that banks create new money only by lending is simply factually incorrect. And again, don't simply take my word for it. In my book, Black Hole, I include many scholarly references to validate this position. And here is one reference from the Bank of England's 2014 paper titled Money Creation in the Modern Economy. Okay, I'll just read the relevant part of this quote. When banks purchase government bonds from the non-bank private sector, they credit the sellers with bank deposits. And as discussed later in this article, central bank asset purchases, known as quantitative easing, have similar implications for money creation. Now, here's a quote from the very excellent book, The Age of Debt Bubbles. In addition to creating money when loans are made to customers, banks also create new money when they make purchases, either from individuals or more commonly, from companies and governments. It is worth reiterating this point. When a bank purchases government bonds, it typically does so by creating new money out of thin air. Okay, our takeaway from Chris's question now is that banks purchasing bonds on the open market and making loans to the public are procedurally equivalent. Banks create money both when they make loans and when they buy bonds in the open market. If you think of a commercial bank as being in the business of acquiring financial assets, which describes both lending and investing, the mechanics become pretty clear. And I go into this simple truth in detail in Chapter 2 of Black Hole. Now, why is Chris's question even important? Why is it so necessary to clear up this confusion about what happens when a bank buys a treasury? Well, the first good reason is that if you think banks don't create money when buying treasuries or other bonds, you will not understand that this kind of activity can be a big potential source of unproductive money creation, also known as inflation. And the second reason this misconception is important is that if you don't see that banks are creating money when buying treasuries in the open market, then you've missed the entire point of the regulatory change of the special leverage ratio. Treasury Secretary Scott Bessent's main purpose in advocating for this change is to allow the commercial banks to increase their balance sheets, meaning owning more treasury bills on the asset side, paid for with new bank deposits on the liability side. So if through this change in regulation, the commercial banks are allowed to buy more treasury bonds, then this means the banks are, by regulation, allowed to create more money. This newly created money is a new source of demand for treasury bonds, and the Treasury Department urgently needs it because they need to find new buyers for their rapidly growing debt. But if you think banks don't create money when buying treasuries, you're not going to understand this potential new source of inflation. So just think about it. It is logical from Scott Bessent's point of view. I mean, he's the head bond salesman for the United States of America. His first job is to fund the government. He's running out of buyers for our burgeoning debt, so he has to turn to the money creators, the commercial banks, to find the new money that'll pay for these bonds. And it's just that simple. If the banks were not money creators, able to absorb a significant portion of this wave of debt, Besant would not care about this SLR rule. If banks were not money creators, there would be no reason for this rule change. Now, in writing Black Hole, I noticed a similar mistake made by people who do not understand the mechanics of quantitative easing. Some of them, who I quoted in my book, believe that when the central bank, the Fed, purchases bonds, it merely creates new cash reserves for the commercial banks that sold them the bonds. Like Chris, they thought the QE transaction was only within the banking system and no new money was created until the banks started to lend more. But that's not correct. It is true that in the early QE process around 2008 or 9, the Fed directly purchased assets from banks and paid them in cash reserves just to boost the bank's liquidity. As a result, some of these initial transactions were simply swaps of bank assets for new cash reserves, all within the banking system. However, most of QE from 2009 to 2022 involved open market purchases, meaning the Fed bought bonds from non-bank investors. These investors all hold accounts at commercial banks. So when the Fed buys a bond from a non-bank investor, it uses the commercial bank as a pass-through to complete the transaction. Here's a diagram of that process. It's a three-way transaction. During QE, as shown in this picture, both the Fed and the commercial banks expand their balance sheets. New money is created in the bond seller's commercial bank account. See that on the right? Reserves in the commercial bank rise by an equal amount. The central bank gains a new asset, the bond, and it also takes on a new liability called cash reserves due to banks. The bond seller swaps his bond for money, which he can then use to buy more bonds or stocks. And then, and when this process is repeated on a large scale, this process added like 7 trillion in new money, spendable commercial bank deposits, or broad money known as M2, between 2009 and 2022. Now, those purchases increased the money supply by 50% in just 13 years. And this QE was the main driver of severe asset inflation during this period. And starting in 2021, it contributed to the increased consumer price inflation, which we are still experiencing. In all markets, money moves prices. And if you don't know how creating new money has inflated both asset prices and consumer prices over the last 15 years, enriching the wealthy while cheating the average wage earner, how creating new money has encouraged our Congress and presidents to spend beyond our ability to pay back the debt that we've incurred. If you don't understand these basics, then you're not in a position to defend your personal wealth when government comes to take it by tax or inflation to pay back what they owe. And that is why I am not willing to let the errors of Judy Shelton, Rand Paul, and Chris to continue to be misunderstood. Now, this brings us to question 2, and this is also from a reader. And it's a related question from John, who wrote, quote, "I am confused. You say that when banks buy treasuries, they create money, but when stablecoin funds buy treasuries, they do not create money. How is that?" John asked a very good question there. My initial reaction was that when a stablecoin issuer buys a T-bill, no new money is created. So here was my reasoning. When you send your money to a stablecoin provider, they issue you a token worth $1 for each dollar you give them. Then they use those dollars to buy T-bills. So your dollar passes from your bank account to the stablecoin provider's bank account, and finally to the T-bill owner's bank account. So money is changing hands, but no new bank deposits are created. So my initial thought was, okay, no new money is created. But upon further thought, I think the answer is more nuanced, and I think I was wrong. Very likely, stablecoins, I think, represent a new kind of money that's created when you buy your stablecoin. So let me elaborate. Von Mises defined money as a commonly accepted medium of exchange. So paper dollar bills and bank deposits are considered money because they're widely accepted in exchange for all goods and services. But now let's consider what happens when you purchase a stablecoin token. It's true that no new bank deposits are created, but you, the customer, now have a token that's designed by law to be used for payment. So no new bank deposits have been created, but there's now this thing called a token that can be exchanged for goods and services as long as both parties in a transaction accept it. So it's somewhat similar to a bank deposit because the issuer must redeem it for dollars in the form of a bank deposit on demand. And that's similar to how the bank has to redeem your bank deposit for paper dollars on demand. So this looks very much like another form of credit money, one step removed from the banks, just as a bank deposit is credit money, one step removed from cash. So upon further reflection, it seems to me that this Genius Act legislation has allowed the stablecoin industry to develop a new form of money. Whether we can correctly call stablecoins money depends on whether they become widely used in everyday transactions. Remember von Mises' definition, money is a commonly accepted medium of exchange. Stablecoins are not FDIC insured, but they are monitored by U.S. regulators, and the fact that they must be backed by short-term, high-quality monetary assets, mostly T-bills, but also guaranteed bank deposits on a one-for-one basis, means that they're probably as safe as any financial asset can be. So if many of us start transacting in stablecoins, which I believe will eventually happen, I think we will have to call them money. So let's think about why people would want to transact in stablecoins. That is how they might become commonly accepted as a medium of exchange. So why would someone prefer to transact in stablecoin versus bank deposits or cash? For most of the people listening right now, I expect they already have a very efficient payment system that costs you, very little or nothing, and it's so lightning fast and invisible, we don't even see what's happening. When I use a bank card or Zelle or Venmo to make a payment for groceries or gas, the underlying financial plumbing is actually complicated, but it works very reliably. Plus, I'm probably getting some interest income on my bank account. However, if I want to send dollars to someone in Mexico, the stablecoin might be a better and cheaper option, better than transporting cash or navigating through several different banks. So as I opined in the last session, I think the most important use case for stablecoins is for people in places where banks are not well established or trustworthy, or where perhaps they charge big transaction fees. Now, there might be other reasons to prefer stablecoins over traditional banking systems. Imagine you travel to Istanbul and go shopping. Many merchants in Turkey would rather accept US dollars rather than the Turkish lira, which loses value against the dollar by about 5% each month. So instead of landing in Istanbul and exchanging your dollars for Turkish lira, or risking using your credit card, you just carry your phone. If the vendor also has a stablecoin account, you can transfer these dollar-denominated tokens to them at the time of purchase. Now, of course, many places in foreign countries do accept Visa and MasterCard, but vendors need to pay a 2% or more fee on each transaction, so they might prefer stablecoin. If they trust the issuer, the stablecoin issuer, and they trust the stablecoin system, they know that they have their money immediately backed by US T-bills, not backed by a privately owned bank that only accepts dollar deposits. So there are a couple of limitations, though, on stablecoins. Unlike banks, the issuers are not allowed to pay interest on your tokens. So I doubt you are going to give up, or we are going to give up our interest-bearing bank accounts, which function very fast and accurately, for a stablecoin unless counterparties to a transaction don't have ready access to a bank account, with dollars. But practically everyone on the planet does have a mobile phone. And setting up a stablecoin account is easy. So for people in places where banks are not available or don't function well, stablecoin may be the answer. So the point is, it appears there are now potentially three forms of money, three components of the broad money supply, where there used to be only two. The first component, of course, is paper fiat currency, usually called currency in circulation. And the second is bank deposits, which currently account for over 90% of all transactions and virtually, all large transactions. But now we have a new category, it appears, and that the new category of money will be stablecoins. Now I'm going to offer an opinion, which I'm not entirely sure about. I don't believe stablecoins are likely to significantly impact the money supply in the near future. So they probably won't be highly inflationary. The US money supply today is about 22 trillion, roughly 19.5 trillion in bank deposits and 2.5 trillion in currency. Currently, the money supply is growing at about 5% per year, which is, somewhat below the average historically. So, but growing 22 trillion at 5% results in about 1.1 trillion per year from bank credit expansion, mainly through lending and bond buying. And how much could stablecoins add to this? The current amount of stablecoins outstanding is about 260 billion, like only a quarter of a trillion. And so stablecoins grow to several trillion over the next 3 to 4 years, which I would think would be ambitious. This would only increase the annual growth rate of the money supply, to about 6% instead of 5%. In my view, that's not enough to cause significant inflation of consumer prices, although there may be some inflationary effects. The main effects of a rise in the use of dollar-based stablecoins would be, in my view, first, support for the dollar versus other currencies, as people demand dollars to access the convenience of stablecoins. However, other currency jurisdictions will likely soon adapt stablecoins, so this advantage could be temporary. Second, I expect stablecoins would give modest or mild support for asset prices, including gold, as the use of stablecoins to pay for investments becomes more popular. And third, I would see a modest tendency to lower the rate of interest paid on T-bills as the demand for T-bills expands. Interest rates on T-bills might decline somewhat. But the main weakness I see in stablecoins is that they cannot, by law, pay interest to the token holder. And as long as the interest rate on T-bills remains meaningful, it's currently at 4.4%, people will be hesitant to give that up when considering stablecoins as a store of value. Okay? All right, so question 3 is a question from a reader named Guy. And he says, hi, Jim, I've enjoyed reading A Black Hole in Economics. You discuss being long precious metal miners. Have you discussed or written why you have an investment preference for miners in contrast to gold directly? Thank you. Well, Guy, thank you for the question. I briefly wrote about precious metal miners in Chapter 8 of Black Hole. To be clear, I do own gold in the form of coins and bullion. In addition, I also invest in precious metals mining companies, and I'll give you a simple example to illustrate why. So the reason miners may be a good way to capitalize on a rising gold or silver price is because of a financial phenomenon called operating leverage. Operating leverage refers to the conditions in which the company's profit margin, which is the ratio of profits to sales, is very sensitive to the sales volume. So if a company's sales go up by 10% and profits go up by more than 10%, we would call this operating leverage. And this often occurs when the company's total revenues are dependent on the price of the product sold, but the costs to produce that product are relatively fixed. This just means that when the price of the commodity sold goes up, sales revenues go way up, but costs do not go up very much, so the profit margin expands. And this is what we mean by operating leverage. So let me give you an example. Here's a simplified example. Imagine that a miner produces 1,000 ounces of gold annually, and the gold price is $2,000 per ounce. So that gives him an annual revenue of $2 million, 1,000 ounces times $2,000 per ounce. Now, after subtracting all costs, let's just say they're 1.8 million, consisting of fuel, depreciation, taxes, salaries, etc. Assume this mine earns a 10% margin on sales, or $200,000 per year. Okay, that's the starting point. Now, next, imagine the gold price rises to $3,000 per ounce while the miner's costs stay the same. So the mine's annual revenue is now 3 million, 1,000 ounces times $3,000 per ounce, minus its costs, still 1.8 million. And profits now have grown from 200,000 to 1.2 million. Therefore, the gold price has increased by 50%, and total sales have also grown 50%. but the mine's profit has gone up by 600%. Now, consider that the mine might sell for 10 times annual earnings, so the mine's market value might increase from 2 million to 12 million. From this very oversimplified example, you can see the leverage that comes to miners from a rising metal price. Now, miners are speculative investments, but they're good ones if you have conviction in the rising gold price, as I do. And I will tell you, if I'm wrong and the gold price declines significantly, that leverage works in the opposite way against you. Operating leverage that results in increased earnings, usually over time, is borne out in stock price performance as the market gradually discovers the improving profitability resulting from the rising price. Now, in the bonus material in the PDF in the Substack, there's a link to podcast that talks about this operating leverage in particular, specifically related to gold miners. I want to give you some graphs now that bear out the fact that operating leverage is working in the market. Over the last full year, the gold price and the prices of gold mining stocks have moved fairly closely together. That's over the last full year. You can see that in the chart on the left. GLD, the blue line, is an exchange-traded fund, ETF, that mirrors the price of gold. GDX, the yellow line, is an ETF composed of the largest publicly traded gold mining companies. And you can see that over the last year, they tracked each other pretty closely. But now look at the right-hand chart to see how gold stocks are starting to outperform the gold price. This is a comparison over the last 6 months. And you can see the gold price starts to level off. That's the blue line. But that happens even as the mining stocks continue to go sharply upward. And this is due to the improving earnings that are starting to show up as the miners' revenues from higher gold prices impact their bottom line. And these stocks are repricing higher as their potential earnings are rising faster than the gold price. Okay, so I own physical gold and silver ETFs, and gold and silver mining stocks. I expect both gold and silver prices to continue rising over time, although I won't speculate on the exact timing. I also expect the mining stocks to continue to outperform the metals. Most people are unfamiliar with, and they rarely invest in these precious metals mining stocks. These investments gain traction in the market. As they gain traction and become more popular for investors, I believe you're going to see the mining stocks rise significantly. Now, here's a big caveat, and I want to emphasize this. If you invest in mining stocks, I strongly suggest that you avoid trying to evaluate these individual companies yourself unless you are genuinely interested in becoming a professional mining analyst, an expert. And I rely on Fred Hickey's recommendations from the High-Tech Strategist. You can see his information on the right-hand side of this slide. Fred Hickey is the most reliable publicly available source I know of on the miners, and his newsletter is quite affordable. It's only $150 per year. It's worked very well for me over many years. He does not have a website, but you can contact him by email at info@thehightechstrategist.com. All right. Now, as usual, what I say here is not investment advice. Consult your own advisor and or do your own research before investing in these volatile markets. All right. That is it for today. I hope I haven't gone too long. In the PDF attached to my Substack, there's some interesting charts on the stock market and on stablecoins in the bone pile section. And as I said, the PDF is full of all kinds of bonus material. So check all that out if you're interested and want to go into any of these points in detail. Thank you for listening, and we will see you next time. Bye-bye now.